Hello and welcome. In this final chapter, we will summarize the key lessons from our IFRS 9 or BFRS 9 training handbook. Throughout this series, we discussed how banks and financial institutions can understand, implement, and review IFRS 9 in practice. We covered classification and measurement, expected credit loss, PD, LGD, EAD, data requirements, governance, disclosures, implementation roadmap, common challenges, templates, working papers, and a comprehensive bank case study. Now, in this closing chapter, we will bring all those lessons together. The objective of this chapter is to provide final practical recommendations for banks, finance teams, risk teams, credit officers, internal auditors, external auditors, senior management, and board members. IFRS 9 should not be treated as only a technical accounting standard. For banks, it is closely connected with credit risk management, loan monitoring, data quality, systems, internal control, audit readiness, regulatory reporting, and board oversight. Therefore, successful implementation requires cooperation among finance, risk, credit, IT, recovery, internal audit, senior management, and the board. Let us now begin with the overall purpose of IFRS 9. BFRS 9. The main purpose of IFRS 9, BFRS 9, is to improve the recognition, measurement, and reporting of financial instruments. For banks and financial institutions, the most important impact is the expected credit loss model. Under the previous incurred loss approach, impairment was generally recognized after a loss event occurred. IFRS 9 introduced a forward-looking impairment model. This means banks should not wait until a borrower actually defaults. Instead, banks must assess credit risk continuously and recognize expected credit losses based on historical information, current conditions, and forward-looking information. This is a major change in thinking. The standard encourages banks to identify credit risk earlier, measure it more carefully, and report it more transparently. IFRS 9 helps improve transparency of financial statements, timely recognition of credit risk, quality of loan loss provisioning, alignment between accounting and risk management, disclosure of credit risk exposure, stakeholder confidence and governance over financial instruments. In simple terms, IFRS 9 is not only about calculating impairment. It is about improving how banks understand and manage credit risk. Let's briefly summarize what we covered in this handbook. In Chapter 1, we introduced IFRS 9 and explained why it is important for banks and financial institutions. In Chapter 2, we discussed classification and measurement. We learned that financial assets are classified based on business model assessment and the SPPI test. The main measurement categories are amortized cost, FVOC, and FVTBL. In Chapter 3, we introduced the expected credit loss model and the three-stage impairment approach. Stage 1 requires 12-month ECL. Stage 2 and Stage 3 require lifetime ECL. In Chapter 4, we discussed practical implementation of ECL, including data, segmentation, model development, forward-looking information, scenario analysis, staging, overlays, systems, and governance. In Chapter 5, we discussed ECL calculation methodology using PD, LGD, and EAD with practical worked examples. In Chapter 6, we focused on data requirements, data governance, and model development. We discussed borrower data, facility data, repayment data, default data, recovery data, collateral information, and macroeconomic data. In Chapter 7, we discussed governance, internal control, audit readiness, and regulatory reporting. In Chapter 8, we discussed disclosure requirements and reporting templates. In Chapter 9, we provided a practical implementation roadmap, training plan, and change management approach. In Chapter 10, we discussed common implementation challenges and practical solutions. In Chapter 11, we provided practical templates, checklists, and working papers. In Chapter 12, we brought everything together through a comprehensive case study of a bank. Now, Chapter 13 summarizes the major learning points and final recommendations. One of the most important lessons is that IFRS 9 implementation is a bank-wide project. It should not be treated as only a finance department task. Although the final numbers are reported in the financial statements, the information required for ECL calculation comes from many departments. The credit department provides borrower information, credit review results, watchlist status, risk judgment information, and borrower risk indicators. The risk department develops PD, LGD, EAD, staging methodology, and forward-looking assumptions. The IT department extracts data from source systems and maintains system controls. The recovery department provides default, legal, collateral, and recovery information. The finance department records journal entries, prepares reconciliation and financial statement disclosures. Internal audit reviews the control environment. Senior management approves significant assumptions and judgments. The board and its committees provide oversight. If these departments do not work together, the ECL calculation may become incomplete, inconsistent, or unsupported. Therefore, banks should form a formal IFRS 9 implementation and review committee with representatives from all relevant departments. The key message is, IFRS 9 is not only a finance project. It is a full bank-wide risk, data, system, governance, and reporting project. Now let us summarize the key lessons from classification, staging, and SICR. First, classification and measurement must be properly documented. Under IFRS 9, classification depends on business model and SPPI assessment. A financial asset cannot simply be classified based on its name. For example, a normal loan may be measured at amortized cost if it is held to collect contractual cash flows, and those cash flows represent solely payments of principal and interest. A debt investment may be measured at FVOCI if it is held both to collect cash flows and to sell. Trading securities and derivatives are generally measured at FVPL. Banks should maintain business model assessment working papers and SPPI checklists. Now let us move to staging. Stage classification is one of the most important parts of IFRS 9 impairment. Stage 1 assets require 12-month ECL. Stage 2 assets require lifetime ECL. Stage 3 assets are credit impaired and also require lifetime ECL. Movement from Stage 1 to Stage 2 and significantly increase impairment allowance. For example, if a loan of BDT 100 million has LGD of 35%, then at Stage 1 with PD of 2%, ECL is BDT 0.70 million. But if the same loan moves to Stage 2 and lifetime PD becomes 15%, ECL becomes BDT 5.25 million. So, staging matters greatly. Now let us discuss SICR, or significant increase in credit risk. A loan may move to Stage 2, even if it is not non-performing. For example, A borrower may be only 10 days overdue, but if its rating has deteriorated, sales have declined and cash flow is weak, the loan may need to move to stage 2. The key message is classification. Staging and SICR should be evidence-based, documented, and consistently applied. Expected credit loss is generally calculated using 3 core components: PD, LGD, and PD. PD means probability of default. LGD means loss given default. ELAD means exposure at default. The basic formula is ALV equals PD multiplied by LGD multiplied by EAD. PD should be based on historical default data, adjusted for current and forward-looking conditions. LGD should be based on expected loss if default occurs, considering collateral, recovery experience, legal cost, recovery delay, and enforceability. AD should reflect expected exposure at the time of default. For term loans, EID may be close to outstanding balance. For revolving facilities, EAD may be higher because borrowers may draw unused limits before default. Collateral is also very important. However, banks should not simply use old market value or recorded collateral value. They should consider updated market value, forced sale value, legal enforceability, ownership dispute, prior charge, recovery cost, selling cost, and time required for recovery. For example, if a loan outstanding is BDT 100 million and old collateral value is BDT 130 million, it may appear fully secured. If updated forced sale value is BDT 80 million and legal and selling cost is BDT 10 million, net recoverable value is only BDT 70 million. Expected loss is BDT 30 million and LGD is 30%. The key messages: PD, LGD, EAD, and collateral assumptions must be reasonable, supportable, and properly documented. Another important lesson is the use of forward-looking information. IFRS 9 requires banks to consider future economic conditions, not only past loss experience. Forward-looking information may include GDP growth, inflation, interest rate, exchange rate, export growth, import cost, unemployment, real estate price, and sector outlook. For Bangladesh, banks may need to carefully consider sectors such as garments, textiles, trading, import-based businesses, real estate, SME, and agriculture. Banks should develop optimistic, base, and pessimistic scenarios and assign probability weights to each scenario. The assumptions should be reasonable, supportable, relevant, approved, and reviewed regularly. Now let us discuss management overlay. Management overlay may be necessary where the model does not fully capture emerging risks or data limitations. For example, if import-based SME borrowers are under pressure due to foreign exchange volatility, management may apply an overlay. But the overlay should not be arbitrary. It should be supported by evidence such as exchange rate movement, repayment trend, sector stress report, 50 settlement pressure, and stress analysis. Every overlay should have a memo explaining reason, affected portfolio, calculation basis, supporting evidence, amount, approval authority, and review date. The key message is forward-looking information and overlays involve judgment, but that judgment must be evidence-based and approved. Data quality is the foundation of IFRS 9 implementation. Good ECL calculation requires good data. Important data includes borrower information, facility information, repayment history, days past due, default history, recovery history, collateral records, write-off data, internal rating history, restructuring and rescheduling records, and macroeconomic data. If data is incomplete or inaccurate, ECL output may be unreliable. Banks should establish formal data governance, including data ownership, data dictionary, source system mapping, data validation, reconciliation, exception reporting, correction process, access control, and audit trail. Now let us discuss systems. Many banks may initially use Excel for ECL calculation. Excel is flexible, but it creates risks such as formula error, wrong cell reference, version confusion, unauthorized changes, manual input error, broken links, and lack of audit trail. If Excel is used, banks should lock formula cells, restrict access, review formulas independently, reconcile input data, maintain version control, keep change logs, prepare backups, and approve manual adjustments. In the long term, banks should move toward controlled system-based ECL calculation. The key message is, without reliable data and controlled systems, even good methodology may produce unreliable results. Reconciliation is essential for IFRS 9 reporting. ECL model output must be reconciled with accounting records. Important reconciliations include loan balance in ECL model versus core banking system, loan balance in ECL model versus general ledger, ECL allowance versus general ledger, write-off and recovery records, disclosure tables versus working papers, and accounting ECL versus regulatory provision. For example, if ECL model output is BDT 311 million, and ECL allowance in the general ledger before adjustment is BDT 950 million, the difference is BDT 361 million. Finance should post additional impairment journal after proper review and approval. In Bangladesh, accounting ECL under IFRS 9 and regulatory provision under Bangladesh bank requirements may differ. Therefore, banks should maintain a clear reconciliation explaining accounting ECL, regulatory provision, difference, reason for difference, and required treatment. Disclosure is also important. Financial statement (CFR) should explain accounting policy, classification, and measurement, ECL methodology, stage-wise exposure, ECL movement, SICR criteria, default definition, forward-looking information, scenario analysis, management overlay, collateral, write-off and sensitivity analysis. The key message is, ECL should be reconciled, explainable, and properly disclosed. Internal audit and external audit both play important roles in IFRS 9 implementation. Internal audit should review governance, data quality, source system controls, access controls, stage classification, SICR assessment, default definition, model validation, overlays, reconciliations, and disclosure process. External auditors will review significant judgments and estimates. They may ask, how were assets classified? What is the business model? Did the asset pass SPPI? How was stage 2 identified? What evidence supports SICR? How were PD, LGD, and EAL-AD calculated? His collateral valuation updated. How were scenarios weighted? Why was management overlay applied? Does ECL's conversal with the general ledger? Are disclosures complete? Board and senior management oversight is also necessary because IFRS 9 can materially affect profit, capital, provisions, and stakeholder confidence. Management should prepare a simple IFRS 9 dashboard for the board. Training is also very important. Training should be provided to board members, senior management, finance, risk, credit, branch staff, IT, recovery, internal audit, and regulatory reporting teams. The key messages: audit readiness, board oversight, and continuous training are essential for sustainable implementation. Based on the full handbook, let us summarize the final recommendations. First, establish strong governance involving finance, risk, credit, ET, recovery, internal audit, senior management, and board committees. Second, develop a practical IFRS 9 policy covering classification, SPPI, impairment, staging, SICR, default, PD, LGD, EAD, forward-looking information, overlays, write-off, disclosure and governance. Third, improve data quality through data ownership, data dictionary, source mapping, validation, and reconciliation. Fourth, develop supportable P, L, G, D, and EAD models. Fifth, define clear staging criteria. Sixth, use forward-looking information properly. Seventh, apply management overlay carefully and with evidence. Eighth, strengthen system and spreadsheet controls. Ninth, maintain strong documentation. 10th, prepare for audit early. 11th, reconcile all key numbers. 12th, train staff regularly. 13th, monitor results after implementation through backtesting and sensitivity analysis. 14th, use ECL results for credit risk management. Banks may also use an annual review calendar. In January, review prior year audit observations. In February, update borrower data and collateral records. In March, review PD, LGD, and EAD assumptions. In April, review staging criteria and SICR indicators. In May, perform data quality assessment. In June, conduct interim ECL calculation. In July, review macroeconomic assumptions. In August, conduct model validation and backtesting. In September, review management overlay framework. In October, prepare draft disclosure templates. In November, conduct audit readiness review. In December, finalize ECL calculation, reconciliation, and management approval. The key messages: IFRS 9 should be managed throughout the year, not only at year-end. Let us conclude the handbook. IFRS 9, PFRS 9. Implementation is a continuous journey. It requires technical knowledge, practical judgment, reliable data, strong systems, governance, documentation, and regular review. For banks and financial institutions, the expected credit loss model is the heart of IFRS 9 implementation. It changes the way banks recognize impairment by requiring earlier and more forward-looking recognition of credit losses. Successful implementation requires more than a calculation model. It requires a culture of credit risk awareness, documentation discipline, and cross-functional cooperation. The finance department cannot implement IFRS 9 alone. Credit, risk, IT, recovery, internal audit, senior management, and the board all have important roles. A bank that implements IFRS 9 properly will be better able to identify credit risk earlier, maintain adequate impairment allowance, improve transparency of financial statements, support regulatory compliance, strengthen internal control, improve audit readiness, enhance board reporting and support, better credit risk management. The final message is simple. IFRS 9, BFRS 9 should not be treated as a year-end accounting exercise. It should be embedded into the bank's regular credit risk management, financial reporting, governance, and decision-making process. A practical, transparent, and well-documented IFRS 9 framework will help banks and financial institutions build stronger financial reporting, better risk management, and greater stakeholder confidence. Thank you for watching this IFRS 9 BFRS 9 training series.